Hello everyone, Chad Frantzen here, and welcome to the Kingdom Finance Show. Today we are going to reveal what you really need to know about the economy, the stock market, and real estate. And we're going to give you action steps to take right now to become a Kingdom Impact investor. It's time to bring clarity out of chaos. Let's get started. Welcome everyone to the Kingdom Finance Show. I'm your host, Chad Frantzen. And thanks for being here. Please like and subscribe to the show and connect with us on social media, Kingdom Finance Show, Chad Frantzen, and our financial advisory firm, Wealth Builders Investments. So you can learn more about what we do there in helping people apply biblical principles, values-based investing to their businesses and personal financial situation, wealthbuilders.net. All right, well, let's dive in today. Today on the show, I want to provide an update on the market. We're into August of 2023 and want to provide kind of a summer, end of summer market update on what's going on. And we could think of this with a question. Is it a soft landing? And so for some of you, you may have no idea what I'm talking about. But some of you may understand that in the markets, what we've been seeing is the economy and the stock market, as I've shared in previous shows, have been very disjointed. There's been a lot of economic data, not good, some good, but a lot that's not good. And the stock market has gone up significantly this year. We call that melting up. So on today's show, I'm going to talk about can the Fed engineer a soft landing? ? And then give you some data points on what's going on as we're at the end of the summer with the stock market, bond market, and then I'll wrap up with just giving you our takeaway and some key things to consider as you're managing your resources heading into the fall of 2023. So let's jump in. Again, the main topic has been the Federal Reserve, as you know, has been raising interest rates. And in fact, they've done their 11th interest rate increase back on July 26th. And that was the 11th rate hike in less than 18 months. Now, if you followed us for some time, you know that interest rates, when you raise interest rates, again, interest rates, let me back up for a moment. Interest rate policy controls the flow of money. If it's easy money or if it's restricted money. And since you and I as consumers make up 2/3 of the U.S. economy, buying homes, buying cars, buying groceries, going out to eat, going to the movies, the flow of money, i.e., the level of interest rates, affects consumer spending. How many of you, by show of hand, would say, yeah, I have noticed that my food expenses have gone way up, or price at the pump has gone way up, going out to eat, buying clothes, buying Legos, you name it. The U.S. government says that inflation has come down significantly, and it's in the 3 to 4% range. And in fact, the CPI, Consumer Price Index, was quoted by the government to be at around 3% at the end of June 2023. But let's be honest here. If you look at your household budget, or if you're a business owner, if you look at your profit and loss, your operating statements, costs are up way more than that. When we think of goods for our home, cost of services, right? All these things, they're probably up 7 to 15%, depending on what type of industry you work in or what part of the country you live in for that. So again, the government language is inflation is coming down. It's down to 3%. Wink, wink. But we know that when it comes down to it, households are still paying significantly higher. And we're not even talking about the price of real estate in line with what mortgage rates are. So there's this concept of a soft landing. And so the narrative has been, as we've come out of COVID and free money, even before COVID, that the Federal Reserve Bank, which is the world's most powerful banking officials in the United States, really the world follows their lead. It's led by Jerome Powell and a board of governors. And they have been raising interest rates to offset inflation. So a lot of the inflation, a lot of it did come from COVID and all the stimulus, but it was already a problem because of government spending and the economy before COVID, and COVID just really threw gasoline onto the fire, and that's how inflation got up to 9% at its peak. That's just the government recorded inflation. I think we all know that true inflation is much higher than that, but it's never reported at the government level. I wonder why. So what the Federal Reserve has been doing in creating policy is raising interest rates consistently to lower inflation, all while not throwing the U.S. economy into a recession where people completely stop spending money, companies start going out of business, corporations do, and the economy, it contracts. It's not growing, it's contracting. So that's been the balancing act. Parts of the economy are already in a recession statistically, but the overall GDP, gross domestic product, of how the U.S. measures is the economy growing, is still above zero. And in fact, in the second quarter of 2023, it was surprisingly robust, growing at an annual rate of 2.4%. So again, we've had the Federal Reserve, they've raised 11 times. They did take a pause prior to the July meeting, and now the federal funds target rate, which is the primary interest rate, is now at 5.50%. Now, for context, for those of you keeping score at home, the federal funds rate in March of 2022 was 0.25. So a quarter of 1% in March of 2022. So now over the last 18 months, that is now up to 5.5%. Now, as I've shared in past shows and conferences, an interest rate increase, it takes it about 6 to 9 months for it to work its way through all of the economy. Think of a wave that starts out in the middle of the ocean. It takes it a while for the current to bring it into shore. It's the same way with monetary policy and what we call the velocity of money. So it takes an interest rate increase in January of this year. It will take it until June or August, September, around now, for it to be fully felt in the economy by the consumer, by small business owner, mom and pop businesses, right? Even medium-sized, large-sized corporations. So bear in mind, with 18 months of interest rate increases, these things are still being absorbed in the economy. So some of you, if you're talking with friends about we can't find a house, we can't afford a house, wow, this is costing a lot more to buy supplies to take our kids back to school. These are all the after effects of a rising interest rate environment. So again, the soft landing, I'm gonna kind of give you my thoughts here at the end. There's two camps here. There's one camp that definitely feels, yes, we're going to have a soft landing, and it's the winds at our back, and everything's going to be green. There's another camp that says not so fast. There could be a major credit event happening. I'll talk about that in my closing thoughts, but those are the contrasting views. And when it comes to how you run your household, how you invest and spend your money, how you run your companies, for those of you that are entrepreneurs, franchise owners, these are very key topics. It's not just for people who want to geek out and are more quantitative in nature. These are actually really important for our businesses, our families, our churches, and nonprofits that we support. So this is something that we want to be very discerning and aware of what's going on. Now, the stock market closing in July of 2023, and by the stock market right now, I'm just talking about the S&P 500. It actually closed about 4.5% below its all-time high. Now, think about that for a second. So the stock market has continued to go up as interest rates are going up. We've got economic data that's good, economic data that's bad, and the stock market just continues this melt up. It closed at 45.88 at the end of July. So really, 4.5% off its all-time high, which happened back in January of 2022. So again, at some point, the concept of financial gravity will have to kick in with a potential credit event, with what's happening in commercial real estate. A lot of corporations are lowering their earnings forecast. And in fact, some data from FactSet revealed that 51% of companies in the S&P 500 having reported earnings, that the S&P is on pace for its worst earnings growth since COVID, since the second quarter of 2022. So those earnings growth potentially standing at -7% to -8%. So a decline in corporate earnings of 7 to 8%. Now, that should mean that if financial gravity is true, that the stock market shouldn't be up, 15, 20% over the last year. Corporate earnings, which is what the markets are priced on, are down 7, 8%, the most since the peak of COVID. So what that means is that corporate earnings are down, stock market is up. It means that valuations are high. So if you live in an area where you think, gosh, real estate prices are still high, same concept applies in the stock market. Well, goodness, rates are up, corporate earnings are down, the most since the peak of COVID, and yet stock prices are only 4 to 5% off their all-time high. What gives? And that really begs the question when we talk about investment strategy, asset allocation, your philosophy to how to invest. Many folks will just follow the adage of buy and hold and ride the wave. That's not my personal approach. It's not my personal opinion for how to do that, but there is a lot of that narrative out there of you just ride the wave. You buy and hold, you put a mix in stocks and bonds, and you just go about your day. So when we look at the stock market, energy was up quite a bit in June and July. Technology has been the best performer, particularly given what's going on with AI, the artificial intelligence movement. Any tech company that says they're doing AI, their stock automatically pops quite a bit because people are really speculating on that. There was a survey that came out from Bloomberg of 23 different equity strategists, and it found that the average price target for the end of this year, 2023, again, now this was done in July. So Bloomberg did a survey of 23 equity strategists. Their average price target for the end of this year, 2023, was 4,245. Okay, so 4,245, and the market at the end of July was sitting at 45.88. So the average equity strategist is expecting the stock market, I'm talking the S&P 500, to be about 7 to 8% below where it is now as we're in the end of summer on that. So again, historically, September, October, very volatile months in the markets, stock, bonds, economy, and so that's a bit of a hey, valuations are extremely high. Don't think that it can overcome financial gravity. So we do expect a bigger correction than that, in my personal opinion. But again, this is just a study by Bloomberg that says, hey, price target for them is 7 to 8% below where it is now. I think, Chad, personally, I think it could be much lower. All right, let's talk a little bit about the bond market here, end of July, going into August. We've shared in some of our shows and conferences about the inverted yield curve. And so an inverted yield curve has an impeccable track record of indicating when and if an economic recession is in the making. And in fact, it's extremely accurate on that. So the bond market, so the yield, the interest rate on a 2-year Treasury bond from the U.S. government versus a 10-year Treasury bond, it's still higher. So in theory, not to get too deep in the weeds here, but if you put money in a 10-year bond, you should get paid higher for holding it longer than if you put money in a 2-year bond. Now, that's the basics of economics, but when it's inverted, it means the bond market says something's out of whack, something's not right here. We're going to pay more to own a 2-year bond, and we're going to pay less to own a 10-year bond. So this is I think it's been 13 months now where the short-term bonds have been higher than long-term bonds. That's what we mean by the term inverted. So it means that an inverted yield curve, as it's called, in other words, you go buy a CD or a bond 6 to 12 months, you're going to earn a lot more than if you go buy one at 5 years or 10 years. That's not the way it should work when the markets are in equilibrium, and it's a very strong indicator for a pending recession. So that's still inverted. It still goes along with our personal thesis on the Kingdom Finance Show that an event is going to happen that'll lead us into a formal recession. And really parts of the economy, when you look at manufacturing and others, are already in that. Well, let's talk a little bit about some takeaways here. Again, I really wanted to focus today's show on just giving you a market update here at the end of the summer, talk about this concept of, can the Fed engineer this quote unquote soft landing? That's a great question. What do you think? I'd love to hear from you. Reach out to us at wealthbuilders.net. Let me know what you think. There's really two main streams of thought here. In effect, Wall Street expects the Fed to pull off a soft landing. Wall Street expects the Federal Reserve to cut. That's right. You heard it. Wall Street expects the Federal Reserve to lower interest rates in order to avoid a recession. So it's almost that idea of like, who's going to blink first? That's the soft landing theory, is that the Federal Reserve will do everything in its power, i.e., lower interest rates, to ensure that a recession is avoided. So that's the Wall Street sentiment. So that's why you're seeing valuations very high when you look at NASDAQ and you look at S&P 500, you look at small caps, mid caps. They'll raise enough to cut inflation down, which they have done a good job of that. However, we know true inflation is much higher than what's being reported, and I'm not so sure we don't see an uptick in inflation even as the government records it. So the Wall Street soft landing theory is, hey, raise it enough, but then as soon as we get on the edge of the cliff, we're going to cut rates. And that is why we're seeing stock prices so high. But why would the Fed cut rates if the economy's growing and inflation is falling? So the narrative, just so we're clear, the narrative right now is from the Federal Reserve is, hey, the U.S. economy measured by GDP is growing, right? I mentioned that earlier in the show. It was a little over 2% annual rate. It's growing. And inflation, CPI, now we know that cuts out a lot of things that we spend and use, but even still, this is the narrative. The economy's growing and inflation is falling. That's what the Federal Reserve wants. So why would they cut rates? The Fed will only cut rates to do one thing, is to offset or circumvent or minimize a recession. So my personal opinion is I believe a major credit event is brewing among corporations and specifically in commercial real estate. There's a lot of loans, a lot of debt on the books of large banks and regional banks in commercial real estate that's coming up for maturity and refinancing in the next couple of years. And that, along with a lot of these corporations who have downshifted on their headcounts with layoffs, downshifted with their earnings, that's where this big domino is going to be that's going to fall, that I think will be the harbinger for a full-blown recession. I do personally think the Fed will quickly cut rates once that happens, but again, that may not be before the stock market drops 20 or 30%. Again, I'm merely stating my opinions here. I'm not giving you financial advice, but it's not like these things work in a organized fashion, right? I mean, just this week, JP Morgan, one of the banks that we encourage folks not to work with, not to invest in because of their values and their support of the woke agenda, JP Morgan came out and said they no longer expect a recession. And the same day that news came out, the S&P 500 fell 50 points and erased about $400 billion in market cap. Well, why is that? JP Morgan just said they no longer expect a recession. Shouldn't that mean that the market's like that and it goes up? My point is that this is organized chaos at best on that. So when we think about takeaways, a couple of takeaways is you want to be very selective in your investment strategy right now in this phase of the economy. You want to be selective in your business spending. You really, whether you're a business owner, franchise owner, or whether you're an investor in companies, you want to be focusing on strengthening your balance sheet. You want to be looking at how you can still grow earnings, profits in a challenging environment. And if you're investing in these companies, you want to look for companies that preferably pay a dividend out of their earnings and look for companies that are not too expensive in their valuation. So if a stock is at its all-time high, multi-year high, that may not be worth investing in. Again, it's a case-by-case basis. But again, these are some of the metrics to follow. We want to be fairly selective on that. Reality is some companies internationally and in emerging markets have a better valuation than some companies in the U.S., which are expensive, particularly in the technology sector. So even for those of us that are business owners, we want to look at strengthening our balance sheet. How do we increase market share, increase our branding, and even if the environment is going to be challenging with what we're going into this fall and into 2024 on that. So I hope that's helpful. Again, closing takeaways here is this concept of the stock market's near its all-time highs. Rates are still high. Wall Street really is anticipating that the Fed is going to cut rates to avoid a recession. I tend to fall on the other side of the camp that feels that may be true that they cut rates to avoid a recession, but not before we have some big domino events like a major credit event amongst corporations and in commercial real estate, even potentially among some regional banks. We had the regional bank failures in the early part of 2023. I still think there's some banks in trouble out there. I think if you look on their balance sheets and what they have going on, there's still some issues brewing in that part of the economy. All that to say, the stock market can turn on a dime, and within a day or two, sentiment can change from being bullish to being extremely bearish, and the market goes down easily 8, 10, 12%, with a blink of an eye. Well, I hope that's been helpful. Again, this is the concept as we head into the fall. There's a more volatile months for the market. Summer tends to be a little bit of the doldrums, right? And this is how it's played out so far in 2023. So be aware of what's going on. Again, we want to be discerning as we navigate the markets and the economy, whether we're investing in real estate, growing our businesses, investing in the stock market, whatever you're doing. I want to encourage you, work with a team of advisors, really seek a multitude of counselors, as the scriptures say, and really pray about how do you grow your business, where do you invest or allocate your resources. I don't want you to be overextended in any one thing, even in your own business. Make sure that you're well diversified alongside what you're doing and in your own personal business. Well, hey, that's all we have for today's show. Thank you for joining us on the Kingdom Finance Show. Again, if you want to find out how to personally apply some of these concepts to your business, your family, and create a kingdom-minded financial investment strategy, financial plan would be another way to say that, that's following a Christian worldview, our team at Wealth Builders Investments would love to help you. So here's how you can get in touch with us. You can find us online and on social media, wealthbuilders.net/invest. If you go to that, we have a free download, and we'd love to connect with you there. And then our team of advisors and planners, we do offer complimentary consultations just to get to know you, point you in the right direction. And again, we're here to help you bring clarity out of chaos when it comes to what's going on in the economy and the markets as it relates to your business, your family, and your finances. So, hey, Chad Frantzen, thanks for joining me today on the Kingdom Finance Show, and we will catch you next time. Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Authentic Counsel, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine risk factors and other information contained in the memorandum.